Ever looked at a company's financial report and felt, well, like you needed a decoder ring just to figure out what's going on? Like it's written in some kind of uh, ancient secret language.
Oh, absolutely.
Yeah,
They can seem really intimidating at first glance.
right. Well, today we're doing more than just cracking the code. We're basically giving you the blueprint.
And honestly, once you understand these core financial stories, it's it's incredibly empowering. Whether you're looking at your own investments or just trying to make sense of the economic headlines, these insights, they really are like a superpower.
Absolutely. In this deep dive, we're cutting through the jargon and getting straight to the heart of how companies tell their financial story. From the, fundamental statements to those crucial, often overlooked details that really reveal the full picture. Our mission for you today is clear: to arm you with the sharpest insights you need to quickly become genuinely well-informed about a company's financial health. We've sifted through, well, tons of financial reporting documents and pulled out only the most important nuggets. So let's unpack this and let's meet our fictional company for the day, Brightstar Innovations. We'll use them as our example.
Sounds good. Brightstar Innovations it is.
Okay, so to truly understand Brightstar, or really any company, we have to start with the core set of financial statements. Think of them like different camera lenses, right? Each capturing a unique angle of the company's financial life.
Hmm.
We're talking about the statement of a financial position. You probably know it as the balance sheet.
Mhm.
The statement of earnings or income statement, the statement of comprehensive income, statement of cash flows, and the statement of owner's equity.
Yeah, they all work together. You need all of them to get the full story.
Exactly. So let's start with the balance sheet.
Okay, the balance sheet specifically, it's like a snapshot, a single moment in time. It shows what Brightstar owns, those are their assets, what they owe their liabilities, and what's left over for the owners, the shareholders, that's their equity. Assets equals liabilities plus equity, basically.
The classic accounting equation.
That's the one. And you'll often see assets and liabilities classified as current or non-current.
Right, based on like how quickly they'll turn into cash or need to be paid off. Within a year, usually.
Typically, yeah. It's a quick way to gauge a company's financial stability at that specific moment.
Okay, so if the balance sheet is that still photograph,
Hmm.
then the income statement. That's definitely the action movie.
Huh. I like that analogy. Yes, it shows Brightstar's performance over a period of time like a quarter or a whole year. It details where their money came from, revenues and gains, and where it went expenses and losses. It's the story of their profit-making engine.
The story of how they made money or lost it.
Exactly. And when you're watching that movie, it helps to understand some key terms. When we talk about revenues and expenses, companies usually report them using the gross concept.
Gross concept, meaning.
It means you see the full amounts. So for Brightstar, their total sales before any returns, or their total salaries paid out, the big numbers.
Got it. But then there are gains and losses, and you said these are reported a bit differently.
Right. They use a net concept. This means they're usually shown after you've subtracted related costs. A gain is typically something outside of Brightstar's ordinary business operations.
Like,
Like if they sold an old piece of equipment for more than its accounting value, its book value, or, the classic textbook example, finding buried treasure on company property. Something unusual
okay, probably not happening often.
and a loss. The opposite, basically. Also outside normal operations.
Yeah.
Maybe selling that equipment for less than book value or abandoning an unprofitable project. The key thing is, these are unusual or infrequent items, so they're shown separately. This helps you see the core business performance clearly.
Right, so you can separate the day-to-day stuff from the one-offs.
Precisely. Knowing this helps you understand a company's, well, its core profitability, assess its investment potential, even judge its creditworthiness. And the income statement is also a really powerful tool for predicting future cash flows. Past performance, especially here, often gives a strong hint of what's coming.
So how do companies actually present this movie of their performance? You mentioned there are two common ways.
Yeah, two main formats. The first is the multiple-step income statement.
Multiple step. Sounds detailed.
It is. It's designed to give you a detailed breakdown. It separates a company's operating activities, the day-to-day stuff, from their non-operating activities, like interest income or those unusual gains we talked about. This format helps you quickly calculate things like gross profit margin or operating income.
Okay, can you walk us through an example, like how would Brightstars look?
Sure. If we look at a typical multiple-step format, like the Radon Industries example from our sources, you'd see net sales right at the top. Then subtract the cost of sales to get the gross margin.
Okay, so sales minus what it costs to make the goods.
Exactly. Then they list out the operating expenses,
Yeah.
selling expenses, general and administrative costs, maybe depreciation, and subtract those to get to operating income.
That's the profit from the main business, right?
Correct. After that, you'd see the other revenues and gains and other expenses and losses sections leading down to income before tax. It's like peeling back layers of an onion.
Gotcha. And the other format.
The other one is the single-step income statement. Much simpler.
Single step. Sounds easier.
It is. It just takes all of Brightstar's revenues and gains, puts them in one big group. Then it takes all their expenses and losses, puts them in another group. Then you just subtract the total expenses losses from the total revenues gains to get income from continuing operations.
So no separation between operating and non-operating.
Nope. It's straightforward, but you lose some of that detail. Using the Radon Industries example again, you'd just see one big total for revenues, one big total for expenses, and then the income figure.
But the final net income number is the same in both formats, right?
Absolutely. The bottom line is the same. The multiple step just gives you more insight on the way down.
Okay, here's where I think it gets really critical for investors, for you listening. What happens when a company like Brightstar decides to, say, sell off a whole major part of its business? Like maybe they had a division that made, I don't know, office furniture, and they decide to get out of that business entirely.
Yes. That brings us to discontinued operations. This is a really important concept for understanding a company's true ongoing health. These results are reported separately on the income statement, way down at the bottom, below income from continuing operations.
Oh, hello.
And they are always shown net of tax, meaning the tax effect related only to that discontinued part has already been factored in.
So what qualifies as a discontinued operation? It can't just be selling off some old computers, right?
Definitely not. It has to be a distinct component of the entity. Think an entire business line, like your furniture division example, or maybe all operations in a specific country. And it has to be either already sold or actively being held for sale.
A significant chunk of the business, then.
Exactly. The key condition is that the disposal must represent a strategic shift that has or will have a major effect on the company's operations and financial results. Think about the Amserv Inc. example from our sources. They sold their entire fast food division to focus on healthier stuff. That's a massive strategic shift.
Okay, that makes sense. So what actually gets reported in that separate section?
Good question. It includes the operating results of that segment, its revenues and expenses, up until it's sold. It also includes any gain or loss from the actual sale itself. And if the asset's value dropped while they were waiting to sell it, any impairment loss is included there too.
Impairment loss, like a write-down.
Precisely. And one crucial detail. Once Brightstar decides to get rid of that furniture division, they stop depreciating its assets. No more depreciation expense for that part.
Okay, so why is seeing this separately so important for us, for the listener?
Because it lets you see the performance of Brightstar's core, ongoing business without the noise, let's say, or the drag from the parts they're ditching. Imagine the all-sports company example. They decide to sell a golf division that's losing money. In year one, while they're trying to sell it, any operating losses from that golf division, and maybe an impairment loss if its value dropped, would be shown separately under discontinued ops.
Right.
Then in year two, when they actually sell it, any operating losses for that part of the year, plus the final gain or loss on the sale itself, would also be reported there.
So it cleans up the income from continuing operations number?
Exactly. It lets you zero in on the true profitability and health of what all sports company continues to do. It gives you a much clearer picture of its future potential without being distorted by the business it's leaving behind.
All right, so we've covered net income, which, let's be honest, is what most people look at first.
The bottom line.
But what if I told you that focusing only on net income means you're actually missing a pretty significant part of a company's financial story? We need to talk about something called comprehensive income.
That's a critical point. Comprehensive income definitely tells a fuller story. It's basically the total change in Brightstar's equity during a period from non-owner sources. Transactions with owners, like issuing stock or paying dividends, don't count here.
Okay, total change in equity from non-owners. How is that different from net income?
It goes beyond net income by including something called other comprehensive income, or OCI.
OCI, okay.
Think of OCI as the holding area for certain gains and losses that aren't considered realized yet or aren't part of the main operating story, so they don't hit the income statement immediately, but they do still impact the company's overall value.
So if net income is the main P&L result, OCI is where? maybe pending or not yet fully baked financial changes live?
That's a pretty good way to put it. These are items that, for various specific accounting rules, are recognized directly in comprehensive income, but bypass net income for the time being.
What kind of items end up in OCI?
The most common examples you'll run into relate to certain unrealized gains and losses. For instance, if Brightstar owns some investments, maybe bonds classified as available for sale, and their market value goes up or down, but Brightstar hasn't actually sold them yet.
So the gain or loss isn't locked in?
Exactly, it's unrealized.
Yeah.
Those changes often sit in OCI until the investment is sold. You also find foreign currency translation adjustments here.
Ah, if Brightstar has operations overseas.
Right. If exchange rates fluctuate, the value of those foreign operations changes when translated back to Brightstar's home currency. Those temporary valuation shifts often flow through OCI. There are others, too, related to pensions and certain types of hedging.
Okay, so these OCI items affect the company's value, but they don't go into net income right away. Where do they go on the balance sheet then? They can't just vanish, right?
No, definitely not. They accumulate over time in a separate component of shareholders' equity on the balance sheet. It's called Accumulated Other Comprehensive Income, or AOCI.
AOCI, accumulated OCI. Makes sense.
Yeah, and here's a really simple way to remember the flow, sort of passkey from the source materials. Net income, the bottom line of the income statement, that ultimately flows into retained earnings on the balance sheet.
Right, profits kept in the company.
But OCI, the other stuff, that flows into AOCI. It keeps these temporary unrealized gains and losses separate until they might eventually be recycled or reclassified out of AOCI and into net income when they become realized. It provides a clear trail of all the changes to a company's equity.
How do companies actually show this comprehensive income number?
They generally have two choices for presentation. One is the single statement approach. Here, all the OCI items are listed individually, usually net of tax, right below the net income line on the main income statement. Then they're summed up to arrive at the final comprehensive income figure. The Sydney Technologies, Inc. example in the sources likely shows this.
And the other way?
Is the two-statement approach. Here, Brightstar would first present its traditional income statement, ending with net income.
Standard income statement.
Then, immediately following that, they present a separate statement of comprehensive income. The second statement would start with the net income figure from the first statement, and then list out and toll the OCI items to arrive at the comprehensive income number.
So, same destination, just two different paths to get there on paper.
Exactly. Both show the full picture of comprehensive income.
And you mentioned these OCI items are often shown net of tax?
Yeah, usually they're reported net of their related income tax effects,
Mm-hmm.
or the tax effects are disclosed separately. And companies have to clearly show the changes in the accumulated balances in AOCI from period to period.
Including those reclassification adjustments you mentioned.
Yes, those are crucial. Reclassification adjustments move amounts out of AOCI and into net income when the underlying gain or loss is finally realized, like when that available for sale bond is actually sold. This prevents amounts from being counted twice, once in OCI and again later in net income. It's all about giving you, the user, the most transparent view possible of all the changes affecting the owner's equity.
Okay, this is great. We've covered the income side, including that broader comprehensive view. Now let's shift gears and focus on the owner's actual stake in Brightstar, shareholders' equity. This is really about, who owns what slice of the pie.
Right. Stockholders' equity or owner's equity, it's simply the owner's claim to the company's net assets. Remember, assets minus liabilities equals equity. It's presented on the balance sheet, of course, and it's usually categorized by where the capital came from. One core concept you'll hear is legal capital.
Well, legal cap.
Yeah, it's basically a minimum amount of capital a corporation is required by law to keep on hand, often related to the par value or stated value of the stock. It's meant as a kind of cushion, a safeguard for the company's creditors.
Par value, I've seen that. It's usually a really small number, like a penny per share.
Often, yes. It's more of a legal formality these days than an economic reality. Don't confuse par value with market value.
Got it. And we also hear about different share counts, right? Authorized, issued, outstanding.
Correct. Authorized shares are the absolute maximum number of shares Brightstar is allowed to sell, as stated in its corporate charter. Issued shares are the ones they've actually sold or distributed to shareholders at some point. And outstanding shares are the issued shares that are currently held by investors outside the company. This count excludes any shares the company might have bought back itself.
Ah, treasury stock. We'll get to that.
Exactly. Understanding these distinctions helps you figure out how much ownership is truly in public hands versus potentially available to be issued later.
Okay, let's break down the two main types of stock you'll typically see. First up, common stock.
Right. Common stock represents the basic ownership interest in Brightstar. The common shareholders are the residual owners,
Residual meaning.
meaning they take on the most risk if the company does poorly, but they also stand to gain the most if Brightstar thrives. They generally control management through their voting rights.
Yeah.
And they get to share in earnings through potential dividends and in assets if the company liquidates, but only after all the creditors and any preferred shareholders have been paid first.
So last in line, but potentially the biggest payoff.
That's the trade-off. Common shareholders might also have preemptive rights.
What are those?
It's the right to buy a proportionate share of any new common stock Brightstar issues. It helps them maintain their existing ownership percentage, preventing their stake from being diluted without their consent.
Interesting. We can also calculate something called book value per common share.
Yeah.
Yes. The formula is basically total shareholders' equity minus preferred equity, divided by the number of common shares outstanding. It tells you, theoretically, how much common shareholders would receive per share if Brightstar sold all its assets at their balance sheet values, their book values, and paid off all its liabilities and preferred claims.
So it's a measure of underlying value based on the accounting numbers, not necessarily what the stock trades for in the market.
Exactly. It's a baseline, often used for comparison, but it's not the market price.
Okay, so that's common stock. What about preferred stock? The name implies it gets preference.
Precisely. Preferred stock is a class of equity that has certain preferences or special rights that common stock doesn't get. These preferences typically involve two main things: dividends and liquidation.
Dividends first.
Preferred shareholders usually get paid a fixed dividend amount, maybe a set dollar amount or percentage of par value, before any dividends can be paid to common shareholders.
Okay, they get paid first.
Yeah.
And liquidation.
If Brightstar were to unfortunately go bankrupt and liquidate, preferred shareholders would get their investment back up to a certain amount, often par value, before common shareholders receive anything.
So less risk than common stock in that sense.
Generally, yes. But often less potential upside, too, because their dividends are usually fixed. Preferred stock can also have some really interesting features.
Like what?
Well, it can be cumulative or non-cumulative.
Cumulative.
Cumulative preferred stock means that if Brightstar misses a dividend payment in a particular year, that missed dividend accumulates. It's called dividends in arrears. And Brightstar must pay all those past accumulated dividends in arrears before they could pay any dividends to common shareholders in the future.
Mm.
The Samuel Cole example in our sources shows how these arrears can stack up.
Wow, okay. And non-cumulative.
If it's non-cumulative, a missed dividend is just lost forever. Tough luck for those preferred shareholders that year.
Got it. What else?
Preferred stock can also be participating or non-participating.
Participating.
Participating means the preferred shareholders might get to receive dividends above their normal fixed rate if the company is doing really well and decides to pay out large dividends. They get to participate alongside the common shareholders in the extra profits. Non-participating means they only ever get their fixed dividend amount, nothing more. The Sanyoko example also shows full participation, where they share proportionally with common stockholders.
Okay, cumulative and non-cumulative, participating, non-participating. Any other features?
Yeah, a few more possibilities. Preferred stock might be convertible, meaning the holder can exchange it for a certain number of common shares. It could be callable, meaning Brightstar has the option to buy it back from the shareholders, usually at a set price. And interestingly, sometimes it's mandatorily redeemable.
Mandatorily, meaning the company has to buy it back.
Yes, at some specific future date or event. And because the company has a firm obligation to pay cash back, mandatorily redeemable preferred stock is actually treated as a liability on the balance sheet, not equity. That's a key distinction.
Huh, that's counterintuitive. Preferred stock treated as debt. Okay.
It's all about the substance of the obligation. Now, besides the par value of stock, companies also have something called additional paid-in capital, often abbreviated as APIC.
Additional paid-in capital. What's that?
It's basically the amount shareholders paid in excess of the stock's par value when the shares were first issued. So if Brightstar issues $1 par value stock for $15 per share, $1 goes to common stock par value, and $14 goes to APIC.
Okay, the extra amount above par.
Right. APIC can also increase from other things, like if the company resells treasury stock for more than it paid, or sometimes from donated capital.
And then the big one we mentioned earlier, retained earnings.
Yes, retained earnings. This represents Brightstar's accumulated profits over its entire life that haven't been paid out to shareholders as dividends. It's the earnings the company has retained or reinvested back into the business.
It's like the company's internal savings account from past profits.
That's a good way to think about it. If this account has a negative balance, meaning the company has accumulated more losses than profits over time, it's called a deficit.
Not a good sign, usually.
Generally not. Now, companies can also sometimes appropriate or restrict a portion of their retained earnings.
Appropriate, like set it aside.
Sort of. It's a disclosure thing. Management might designate a portion of retained earnings for a specific purpose, like future plant expansion or potential lawsuit losses. This just signals to shareholders that this particular amount isn't available for dividends right now.
But the cash isn't actually moved anywhere, right? It's just an accounting entry.
Exactly. It's just earmarking within retained earnings. It does
Okay.
not set aside cash, and it's not used to absorb actual costs when they happen. It's purely informational.
Okay. And we should also remember accumulated other comprehensive income, AOCI, it's in equity too.
Correct. Circling back to that, AOCI is kept separate from retained earnings and paid-in capital because, as we discussed, its components haven't flowed through net income yet. It's another distinct piece of the total equity puzzle.
So putting it all together, capital stock, par value, additional paid-in capital, retained earnings, and AOCI. Those are the main sections of equity.
And potentially treasury stock as a reduction, yes. Those are the core components.
Okay, let's talk about that reduction. Why would a company like Brightstar buy back its own stock? You called it treasury stock. It seems a bit counterintuitive.
It does seem odd at first, but it's actually a very common and often strategic move. Treasury stock is simply Brightstar's own stock that it previously issued but has now reacquired from the open market or directly from shareholders and hasn't officially retired it.
Okay, so they buy it back, but they don't cancel it.
Right, they hold it in the treasury, so to speak. Now, a key point. When a company holds treasury stock, those shares lose their voting rights and they don't receive any dividends.
Why do companies do it?
Several reasons. They might think their stock is undervalued and buying it back is a good investment. Buying back shares reduces the number of shares outstanding, which can boost metrics like earnings per share, EPS. It can signal management's confidence in the company's future, or they might need the shares for employee stock option plans or acquisitions.
Okay, that makes sense. How is it shown on the balance sheet?
It's shown as a reduction of total shareholders' equity. There are two main accounting methods, but the cost method is by far the most common.
Cost method.
Yeah, under the cost method, Brightstar simply records the treasury stock at the price it paid to reacquire the shares. It shows up as a negative number in the equity section.
And what happens if they resell those treasury shares later? Say they bought them for $20 and resell them for $25. Is that a $5 gain on the income statement?
Excellent question, and a crucial point for you listening. No, it is never a gain or loss on the income statement. Transactions in a company's own stock are considered capital transactions, not operating activities.
So where does that extra $5 go?
If treasury stock is reissued for more than its cost, the gain increases. Additional paid-in capital specifically, a subaccount often called APIC treasury stock.
Okay, straight to equity. What if they resell it for less than cost? Say they bought at $20 and sell at $18, a $2 loss.
Again, not a loss on the income statement. That loss first reduces any existing balance in that APIC treasury stock account from previous gains. If that's not enough to cover the loss, or if there's no balance, then the difference reduces retained earnings directly.
Wow, okay. So gains and losses on treasury stock bypass the income statement entirely and hit equity directly. That's a really important distinction.
Huge distinction. Remember, gains and losses on treasury stock transactions. Equity, not net income.
Got it. What if the company decides to officially retire the treasury stock instead of reselling it?
Retirement basically cancels the shares. The accounting reduces the original common stock, par clack, and the related additional paid-in capital that was recorded when the shares were first issued. Any difference might affect APIC from treasury stock or retained earnings, similar to reissuance below cost.
Okay, and one last thing here. What about donated stock? If someone gives shares back to the company?
If Brightstar receives its own shares back as a donation, it's recorded at fair market value at the time of donation. The offset. A credit to, you guessed it, additional paid-in capital, donated capital. It increases equity but doesn't involve cash initially, and those donated shares become treasury stock if not retired.
Okay, equity is definitely complex but super important. Now that we've covered the different types of stock and how equity changes, let's talk about how Brightstar actually issues shares to begin with, and
Right.
then the really exciting part for many shareholders, how they make distributions through dividends.
Right. When Brightstar initially issues stock, the transaction increases cash, or whatever they received, and increases equity specifically, capital stock for the par value, and additional paid-in capital for the excess over par. Sometimes a company might sell stock on credit. This uses stock subscriptions.
Selling stock on credit, how does that work?
They basically take promises to pay. They record a subscriptions receivable, an asset like an IOU from the subscriber, and credit common stock subscribed, an equity account. The actual shares usually aren't issued until the subscriber pays in full, then the receivable goes away, and common stock subscribed becomes regular common stock and APIC.
Okay. And you mentioned stock rights earlier with preemptive rights.
Yes, stock rights give existing shareholders the option, the right, to buy more shares, usually at a price slightly below the current market price for a limited time. It's a way to raise capital while giving current owners a chance to maintain their proportional ownership. There's usually no journal entry when the rights are issued, only when they're exercised and shares are actually purchased.
Gotcha. Okay, now, dividends, the reward for shareholders.
Indeed. A dividend is simply Brightstar's way of distributing a portion of its earnings back to its shareholders, usually on a pro rata basis, meaning in proportion to the number of shares they own.
Are there important dates associated with dividends?
Yes, 3 key dates. First, the date of declaration. This is when Brightstar's board of directors formally approves the dividend. On this date, the dividend becomes a legal liability for the company. They record an entry to decrease retained earnings and increase dividends payable, a liability.
Okay, the company owes the money now.
Second, the date of record. This date determines which shareholders are actually entitled to receive the dividend. If you own the stock on this date, you get the dividend. There's no journal entry on this date. It's just an administrative cutoff.
So if I buy the stock after the date of record, I don't get that dividend.
Correct. The seller would get it. And third, the date of payment. This is when Brightstar actually pays the cash or distributes the property to the shareholders recorded on the date of record. The entry here decreases cash and decreases the dividends payable liability.
Declaration, record, payment, got it. What types of dividends are there? Just cash.
Cash dividends are definitely the most common. They're paid from retained earnings, and importantly, only on outstanding shares. Treasury stock doesn't get cash dividends, but companies can sometimes pay property in kind, dividends.
Property, like they mail shareholders some inventory.
No, maybe not inventory, but perhaps shares they own in another company or some other non-cash asset. When this happens, the property being distributed must first be restated to its fair market value on the date of declaration. Any difference between fair value and book value is recognized as a gain or loss on the income statement this time.
Ah, okay, so a gain or loss can hit income here.
Yes, because you're disposing of an asset. Then the dividend itself is recorded at that fair market value, reducing retained earnings.
Interesting. Any other types?
Less common are scrip dividends. This is basically an IOU.
Yeah.
Brightstar says, we owe you a dividend, but we're a bit short on cash right now, so here's a note promising to pay you later, often with interest. It creates a notes payable liability.
Okay, a deferred cash dividend.
Essentially. And finally, there are liquidating dividends. This happens when a company pays out dividends that actually exceed its balance in retained earnings.
Paying out more than they've earned and kept. How?
The portion of the dividend that exceeds retained earnings is considered a return of the shareholder's original investment, not a distribution of profits. That excess amount reduces additional paid-in capital, not retained earnings. It's basically giving capital back to the owners.
Right, liquidating part of their investment.
Right.
Makes sense. Okay, now let's tackle stock dividends and stock splits. They sound similar, people often confuse them, but you said they have different impacts.
They do, and it's a really common point of confusion. Let's clarify. A stock dividend is when Brightstar distributes more shares of its own stock to its existing shareholders instead of cash.
So I own 100 shares, and they give me 10 more shares.
Exactly. Now, the accounting depends on the size of the stock dividend relative to the number of shares already outstanding. For a small stock dividend, generally defined as less than 20-25% of the outstanding shares.
Like your 10% example, 10 shares on 100.
Right. For a small one, the idea is it's probably not going to significantly reduce the market price per share. So the company transfers the fair market value of the shares being issued from retained earnings to capital stock for the par value and additional paid-in capital for the excess.
So retained earnings goes down by the market value of the new shares.
Correct. But notice, your total shareholders' equity doesn't change. Money just moved from one equity pocket, retained earnings, to other equity pockets, capital stock and AP. It's just a reclassification within equity. The Capital Corporation 5% example in the sources illustrates this transfer at fair value.
So as a shareholder, I have more shares, but the total value of my holding, based on book value, hasn't really changed.
Precisely. You have more smaller pieces of the same pie. Now, for a large stock dividend, usually defined as more than 20–25%.
Like maybe a 50% stock dividend.
Yes. The accounting treatment is different. Because a large stock dividend is expected to materially reduce the market price per share, it's treated more like a stock split for accounting purposes. Only the par value of the shares issued is transferred from retained earnings to capital stock. No APIC involved here typically. The LMT Corp. 40% example shows this par value transfer.
Okay, small dividend uses market value, large dividend uses par value for the transfer from retained earnings. But in both cases, total equity is unchanged.
Correct. Total equity remains the same. It's just shuffling funds within the equity section.
What about stock splits then? How are they different?
A stock split also results in more shares outstanding, but it works differently. Here, Brightstar issues additional shares to shareholders and proportionally reduces the par value per share.
Reduces the par value.
Yes. For example, in a 2-for-1 stock split, Brightstar gives you 1 additional share for every share you own, so you double your shares. But they also cut the par value per share in half. If you had 100 shares at $1 par, after a 2-for-1 split, you'd have 200 shares at even 50 cents.
Ah, I see. So the total par value outstanding shares x par value stays the same.
Yeah.
100 by $1 equals 50 cents, and 50 cents equals $100.
Exactly. And because the total par value doesn't change, and no value is transferred from retained earnings, there is no journal entry required for a stock split. It's just a memorandum entry in the accounting records noting the change in par value and the new number of shares outstanding.
No accounting entry at all, just a note.
Just a note, total book value of shares outstanding and total shareholders' equity do not change. It's purely about changing the number of shares and their par value, often to make a stock price per share lower and potentially more attractive to smaller investors.
So stock dividend reclassification within equity using FMV or par. Stock split, no equity reclassification, just change par value in shares, memo entry only.
Got it.
Year.
Nailed it. And of course, there are also reverse stock splits, which do the opposite, reduce the number of shares and increase the par value proportionally. Same logic, no journal entry usually required.
This is great for understanding the mechanics. Now, with all these potential changes impacting equity over time, issuing new shares, net income flowing into retained earnings, OCI flowing into AOCI, dividends coming out, treasury stock transactions, stock splits, how do we, as informed observers, keep track of it all? How do we see the whole picture of these movements?
That's exactly the purpose of the statement of changes in shareholders' equity, sometimes called the statement of stockholders' equity.
Okay, another one of the core statements.
Yes. This statement provides a complete reconciliation, column by column, of the beginning and ending balances for each major component of equity. It typically has columns for common stock, preferred stock, if any, additional paid-in capital, retained earnings, accumulated other comprehensive income, and treasury stock.
So it shows how each piece changed during the year.
Precisely. It starts with the beginning balance for each column, then details all the transactions that affected each one during the period. Things like net income increasing retained earnings, dividends decreasing retained earnings, stock issuance increasing common stock and APIC, OCI increasing or decreasing AOCI, treasury stock purchases decreasing total equity. It ends with the ending balance for each component, which should match the amounts shown on the balance sheet.
It's like a detailed roadmap showing exactly how the owner's stake in Brightstar evolved from the start of the year to the end.
Perfect analogy. A roadmap or a timeline. It allows you to trace every significant change. The Sydney Technologies, Inc. example table mentioned in our sources probably lays this out clearly. It's incredibly useful for understanding the full dynamics of equity.
Fantastic. Okay, so we've gone through the main financial statements, balance sheet, income statement, including discontinued ops, comprehensive income, and now the statement of changes in equity. But we know the story doesn't end there. Let's move into the fine print, the critical context, the notes to financial statements and other important disclosures. This is really where you get the full story, isn't it? The narrative behind the numbers.
Absolutely. If the financial statements are the skeleton, the notes are the muscles, nerves, and circulatory system that bring it to life. The notes to financial statements are truly indispensable for a proper understanding.
Where do you even start with the notes? There can be dozens of pages.
Usually the very first note, or one of the first, is the summary of significant accounting policies.
Significant accounting policies sounds important.
It is. This note is crucial because it tells you the specific accounting methods and principles Brightstar chose to use in preparing its financial statements, especially where accounting rules allow for choices.
What kind of choices?
Things like which depreciation method they use for their assets, straight line, declining balance, how they value their inventory, FIFO, LIFO, weighted average, the basis they use for consolidating subsidiary companies, and importantly, it highlights areas where significant estimates were required.
So it's like the rule book they followed.
Exactly. It tells you the how. This summary doesn't usually include detailed dollar amounts. It's focused on the methods, principles, and assumptions applied.
Okay, so that sets the stage. What about the rest of the notes?
The remaining notes provide all the supporting details and supplemental information that couldn't practically fit on the face of the main statements. This is where you find the real nitty-gritty.
Like what kind of nitty-gritty?
Oh, all sorts of things. Detailed breakdowns of inventory types,
Yeah.
property, plant, and equipment, information on debt agreements, including interest rates and maturities, details about leases, information on marketable securities and investments, how they calculated fair value for certain assets or liabilities. You'll also find crucial information on potential losses from lawsuits or other contingencies, details about commitments and contractual obligations, information about pension plans and other post-retirement benefits, segment reporting, breaking down results by business line or geography, and, very importantly, disclosures about subsequent events and any changes in accounting principles. It's a treasure trove of context.
Wow, okay, so you really do need to read the notes. Part of that context you mentioned involves risks, right?
Yes, another vital part of the disclosures covers risks and uncertainties. GAPA requires companies to talk about potential future impacts. This usually starts with the nature of operations, basically explaining what Brightstar does, its main products or services, its principal markets, just setting the scene.
Okay.
Then, critically, it highlights the use of estimates in preparing the statements. It's an explicit reminder that financial statements aren't perfectly precise. They require management to make significant judgments and estimates about future events, and actual results could differ, sometimes materially.
Like estimating bad debt expense or the useful life of equipment?
Exactly. And related to that, if there are certain significant estimates where it's reasonably possible that the estimate will change in the near term, usually within 1 year, and the effect of that change would be material, the company must disclose the nature of that uncertainty.
So if they have a big pending lawsuit and the outcome is uncertain but could be very costly, they need to mention that estimate uncertainty here.
Precisely. Or maybe estimates about inventory obsolescence or the valuation of deferred tax assets, highlighting the really sensitive estimate.
Makes sense. What else under risks?
The final piece is current vulnerability due to certain concentrations.
Concentrations, like putting all your eggs in one basket.
Pretty much.
Yeah.
This disclosure is required if Brightstar is exposed to a significant risk because it's heavily reliant on something specific, and that reliance makes it vulnerable to a potentially severe negative impact in the near future. Maybe relying on a single large customer for most of its revenue, or a single supplier for a critical component, or having all its operations in one specific geographic area prone to natural disasters, or deriving most revenue from one specific product facing potential regulatory changes.
So if losing that one customer or supplier could cripple the company.
Right. If the concentration exists, makes the company vulnerable to a near-term severe impact, and it's at least reasonably possible that the events causing the impact will occur, then disclosure is required. It's about warning investors about risks that maybe diversification could have mitigated.
Okay, that's really helpful transparency. Now, you mentioned subsequent events a couple of times. What about things that happen after the balance sheet date, say December 31st, but before the company actually issues its financial statements to the public, which might be in February or March? That seems like a critical window.
You're absolutely right, it is. Subsequent events are events or transactions that occur in that specific window. After the balance sheet date, but before the financial statements are officially issued or available to be issued, the accounting treatment depends on what the event tells us.
How so?
They fall into two categories. First, recognize subsequent events. These are events that provide additional evidence about conditions that already existed at the balance sheet date.
Conditions that existed before year end.
Yes. Because they relate to past conditions, these events require actual adjustment to the amounts in the financial statements.
Can you give an example?
Sure. Let's say Brightstar was involved in the lawsuit that started before December 31st. If that lawsuit is settled for a specific amount in January, before the statements are issued, that settlement provides concrete evidence about the value of the liability that existed at year-end. So Brightstar should adjust its recorded liability based on that settled amount.
Okay, it confirms or clarifies something from the past year.
Exactly. Another common example. If a major customer declares bankruptcy in January, and this bankruptcy confirms that the receivable Brightstar had from that customer at December 31st was uncollectible, that's a recognized subsequent event. Brightstar should adjust its allowance for doubtful accounts. The Friends of Fido example in our sources shows both a lawsuit settlement and a customer bankruptcy like this.
Okay, those require adjusting the numbers. What's the other category?
The second category is non-recognized subsequent events. These are events that provide evidence about conditions that did not exist at the balance sheet date, but arose after that date.
So completely new information.
Right. Because these conditions didn't exist at year-end, they do not require adjustment to the financial statement numbers themselves. However, if these events are material, they do require disclosure in the notes to the financial statements.
Disclosure, but no change to the balance sheet or income statement numbers.
Correct. Examples might include Brightstar issuing a large amount of new bonds or stock in January, or making a major business acquisition after year-end, or suffering a significant fire or flood loss at one of its facilities in February. These are important events for investors to know about, but they reflect conditions of the new year, not the year just ended.
So the Friends of Fido example might show something like planning an acquisition or a flood wiping out a customer after year-end as non-recognized.
Exactly. Those would require disclosure in the notes accompanying the December 31st financial statements, describing the event and maybe its estimated financial effect, if possible, but no adjustment to the December 31st numbers themselves.
Is there a specific cutoff date for considering these subsequent events?
Yes, the company has to evaluate events up until the date the financial statements are actually issued for SEC filers, or are available to be issued for non-SEC filers. They also have to disclose that date.
Okay, this makes me wonder about something you mentioned earlier when talking about notes. Fair value measurements. How exactly do companies determine the fair value of certain assets or liabilities, especially when there isn't a clear active market price, like for a unique building or a private investment?
That's a fantastic and often complex question. GAAP has specific guidance on fair value measurements. Fair value is defined very precisely. It's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date.
Okay, that sounds specific. Let's break that down. Orderly transaction.
It means it's not a forced sale or liquidation. There's been sufficient time and market exposure to find a willing buyer.
Market participants.
These are buyers and sellers in the principal or most advantageous market for the asset or liability. They need to be independent, knowledgeable about the asset, able and willing to transact. It's not based on Brightstar's specific view, but the market's view.
Okay, and principal or most advantageous market.
The principal market is the one with the greatest volume and level of activity for that asset or liability. If Brightstar can access that market, the price in that market must be used for fair value, even if a better price might exist elsewhere after costs. If there's no obvious principal market, then Brightstar looks for the most advantageous market. That's the market that maximizes the amount received for the asset, or minimizes the amount paid for the liability after taking transaction costs into account.
Ah, so transaction costs help you find the best market.
Yes, but here's a key point. While transaction costs, like broker commissions, are used to determine which market is most advantageous, they are not included as part of the final fair value measurement itself. Fair value is the price before those costs. The Gertie Inc. Foxyco stock example in the sources clearly illustrates finding the most advantageous market, but excluding transaction costs from the fair value measurement.
Okay, that's tricky but important. Price before transaction costs. What about things like buildings or land non-financial assets?
For non-financial assets, fair value is based on their highest and best use from a market participant's perspective. This might be different from how Brightstar is currently using the asset. It considers what use would generate the maximum economic benefit.
Got it. How do accountants actually calculate fair value if there's no direct market quote?
They use various valuation techniques. The main approaches are the market approach. Uses prices and other relevant information from market transactions involving identical or comparable assets or liabilities, like looking at recent sales of similar buildings in the area. The income approach converts future amounts like expected future cash flows or earnings to a single current discounted amount. Think discounted cash flow, DCF analysis. And the cost approach reflects the amount that would currently be required to replace the service capacity of an asset, often called current replacement cost.
Okay, market income cost approaches. But the inputs used in these techniques must vary in reliability, right? A stock quote seems more reliable than a company's own cash flow projection.
Absolutely. And that's why GAAP establishes a hierarchy of inputs for fair value measurements, often called the fair value hierarchy. It categorizes inputs into 3 levels based on their observability and reliability. Think of it like a reliability ladder.
Level 1, top rung.
Level 1 inputs are the most reliable. Quoted prices, unadjusted in active markets for identical assets or liabilities that Brightstar can access at the measurement date. This is like looking up the price of IBM stock on the New York Stock Exchange. Easy, observable, reliable. The Marker 8 company stock example likely fits here.
Okay. Level 2, middle rung.
Level 2 inputs are inputs other than quoted prices included within Level 1 that are observable for the asset or liability, either directly or indirectly. This includes quoted prices for similar assets in active markets or quoted prices for identical or similar assets in markets that are not active. It also includes inputs like interest rates, yield curves, or credit spreads that can be observed.
So maybe valuing a corporate bond based on observable interest rates and credit spreads for similar bonds.
Exactly. Or valuing a building based on prices per square foot of similar buildings recently sold. Observable, but requires some adjustment or comparison.
And level 3, bottom rung.
Level 3 inputs are unobservable inputs. These are used only when observable inputs, level 1 or 2, are not available. Level 3 inputs reflect Brightstar's own assumptions about what market participants would use in pricing the asset or liability, developed using the best information available. This often involves significant judgment and modeling, like using a complex internal model to value a private equity investment.
Least reliable, most judgment involved.
Correct. And because of that, companies have to provide significant disclosures about their level 3 measurements, including the valuation techniques used, the specific unobservable inputs, and sensitivity analysis showing how changes in those inputs might affect the valuation. They must also disclose the level 1, 2, or 3 for each major category of assets and liabilities measured at fair value.
Wow. Okay, so we've covered how the statements are built, the crucial details in the footnotes, subsequent events, and even how companies arrive at those tricky fair value numbers. Now, the million-dollar question. What does this all mean for you, the listener? How do we actually use all this carefully prepared information to assess a company like Brightstar? This is where the rubber meets the road, right?
This is indeed where you move from just understanding what the numbers are to understanding what they're actually telling you about the company's health and performance. And ratio analysis is an incredibly powerful tool for doing just that.
Ratios, we hear about them all the time. PE ratio, current ratio.
Exactly. Ratios are simply financial indicators calculated by dividing one financial statement item by another. They quantify relationships between different pieces of financial data. Their real power comes from comparison. They help you identify trends within Brightstar over time. Is its profitability improving or declining? Or compare Brightstar's performance against its competitors or industry averages. Is it more or less efficient than its peers? They turn those raw numbers into meaningful insights.
Okay, but sometimes working out if a ratio going up or down is good or bad can be confusing, especially if both the top and bottom numbers change.
It can be. Here's a quick mental trick, sometimes called a pass key in study materials, that can help. Remember that the numerator, the top number in the ratio, generally has a direct relationship with the ratio. If the numerator goes up and the denominator stays the same, the ratio goes up. The denominator, the bottom number, generally has an inverse relationship. If the denominator goes up and the numerator stays the same, the ratio goes down.
Okay, direct for top, inverse for bottom.
Right. Now, if both change, and it gets tricky to visualize, just make up simple numbers. Plug in easy numbers like 10 and 5, see what the ratio is. Then change one or both according to the scenario and recalculate. It often makes the direction of the change immediately clear.
Good tip. Make up numbers. Okay. What kinds of ratios should we focus on?
They're typically grouped into categories based on what they measure. For example, profitability ratios. These tell you how successful Brightstar is at generating profit from its operations. Think gross profit margin, net profit margin, return on assets, ROA, return on equity, ROA. Higher is generally better here.
Measuring the profit engine.
Exactly. Then you have liquidity ratios. These measure Brightstar's ability to meet its short-term obligations as they come due. Can they pay their bills? The most common are the current ratio, current assets, current liabilities, and the quick ratio, or acid test ratio, which is similar but excludes inventory from current assets because it's less easily converted to cash.
Right, like the ghee company examples of our sources. If their current and quick ratios are way below the industry average, that's a red flag.
It could definitely be a red flag, yes. It might suggest they could struggle to pay suppliers or meet payroll in the near term. Liquidity also includes turnover ratios, like accounts receivable turnover, how quickly they collect cash from customers, or inventory turnover, how quickly they sell their inventory. These feed into the cash conversion cycle, which measures how long it takes from spending cash on inventory to getting cash back from customers. Shorter is usually better.
Okay, profitability, liquidity, what else?
Solvency ratios. These look at Brightstar's long-term financial health and its ability to survive over a longer period. They measure the company's ability to meet its long-term debt obligations. Examples include the debt-to-equity ratio, how much debt versus equity finances the company, and the times interest earned ratio, how easily the company can cover its interest payments with its earnings. They assess financial risk or leverage.
Long-term stability.
Right. And finally, there are various performance metrics often used by investors. Things like EBITDA, earnings before interest, taxes, depreciation and amortization, earnings per share, EPS, the price to earnings, PE ratio, dividend payout ratio, and asset turnover. These often combine market data with accounting data.
So lots of ratios, but they're not perfect, are
The
they?
no tool is. Ratios are powerful, but you need to be aware of their limitations. They rely on accounting data, which is based on historical costs and includes estimates, so the quality of the ratios depends on the quality of the underlying data. Different accounting methods, like FIFO versus LIFO for inventory, can also affect comparability between companies. That's why ratios are best used as part of a broader analysis. You should look at trends over time, compare carefully against appropriate benchmarks, and combine ratio analysis with other techniques like horizontal analysis, looking at percentage changes year over year, and vertical analysis, common-size statements where everything is shown as a percentage of a base like total assets or total sales.
Right, don't just look at one ratio in isolation. Get the bigger picture. Okay, one more area. Beyond looking at past performance with ratios, how do companies measure their current performance against their own internal plans or budgets? Like, if Brightstar budgeted to spend $1 million on marketing, but actually spent $1.1 million, how do they analyze that difference?
That's where variance analysis comes in. It's a fundamental management accounting technique used for planning and control. It involves comparing Brightstar's actual results to what was planned or budgeted, and then analyzing the differences or variances.
So, budgeted marketing $1, actual one-time one-on, and the variance is $100,000 unfavorable.
Exactly. But the real value comes from understanding why that variance occurred. Was it just poor cost control? Or did they maybe sell more products than expected, requiring more marketing support? A simple comparison of actual results to the original static budget can sometimes be misleading, especially if the actual level of activity, like sales volume or production volume, was different from the budgeted level. We'll look at the Neostar Corporation example from our sources. If their sales volume was lower than budgeted, their actual variable expenses, like materials or direct labor, would likely also be lower than the static budget. This might show a favorable variance, making it look like they controlled costs well.
But maybe they didn't control costs well per unit. They just made fewer units.
Precisely. That favorable variance might just be due to the lower volume, not actual efficiency gains. This is why flexible budgets are often a much more insightful tool for variance analysis.
Flexible budgets. How are they different?
A flexible budget adjusts the budgeted revenue and cost amounts based on the actual level of output or activity achieved during the period. Instead of comparing actual results to the original static budget based on planned volume, you compare actual results to a budget that's been flexed or adjusted to what costs should have been for the actual volume achieved.
So it isolates the impact of volume changes.
Exactly. By using a flexible budget, Neostar's management could compare their actual variable costs at the actual production level to what the variable costs should have been at that same production level according to their standards. This would reveal if they were truly efficient, a favorable flexible budget variance, or inefficient, an unfavorable flexible budget variance in controlling costs per unit regardless of the overall volume change. It provides much more meaningful insight for performance evaluation and accountability.
That makes a lot more sense for understanding true operational performance. Okay, we have covered a ton of ground today.
We certainly have.
So let's try to wrap this up. What does this all mean for you, our now very well-informed listener? We've journeyed through the real intricacies of financial reporting, from the basic structure of the key statements to digging into discontinued operations, comprehensive income, the details of equity, the crucial footnotes, fair value debates, and finally, how to analyze it all with ratios and variance analysis. You really should now have a much deeper understanding of how companies like our friend Brightstar communicate their financial health and performance.
And if we try to connect this to the bigger picture, I think the key takeaway is remembering that every number really does tell a story. But crucially, the context provided through those detailed disclosures in the notes and the perspective gained from analytical tools like ratios is just as important, if not more important, than the headline figures like net income. Critical thinking, asking why, digging deeper, that's absolutely essential, especially today with so much information coming at us. And hopefully, with what you've learned in this deep dive, you're much better equipped to do that digging.
Absolutely. And this really raises an important final thought, maybe a challenge for you to carry forward. As you encounter financial reports now, maybe for companies you invest in, companies in the news, maybe even your own employer, what new questions will you ask based on what we discussed today? What new insights will you look for beyond just the obvious bottom line number? What hidden stories do you think might be waiting there for you to uncover in those notes, in those ratios, in those comprehensive income figures?
That's the real goal, isn't it?
Well,
To look beyond the surface.
exactly. Well, thank you so much for joining us on this pretty intensive deep dive into the world of financial reporting.
My pleasure. It was great digging into it.
Until next time, keep digging for those insights.